Today, I want to compare buying a $1 million investment property with buying a $1 million established business. We're going to put them side by side, how much cash you need to put in, how much you need to borrow, the cost of that debt, the cash flow you're left with after tax and loan repayments, and most importantly, where you end up after 5 years. Now, I'm not doing this to tell you that buying a business is better than buying property, because they're very different investments with very different risks. But when you actually put the numbers next to each other, the comparison is really interesting. So let's start with the two assets worth exactly the same amount, $1 million. Here's the property and here's the business. So let's start with the cash that's invested. And when we say cash, we're talking about either cash at bank or borrowable equity. Borrowable equity is generally 70 to 80% of the equity that you've got in a property, depending on which lender. The thing is, when you buy a business, you're buying also a significantly greater level of serviceability, because the banks will consider that business income as what can service the debt. You don't really get that with investment property. You're only getting the rent as the serviceability. Now, if you have a look at the debt then on the investment property, $900,000 versus $500,000. So you've put a lot more in upfront to buy the business and a lot less in upfront to buy the property. So that gives you LVR ratios of 90% and 50% respectively. Now, this is the first assumption. This may vary slightly, but illustrative interest rates will be 6.31% because it's a residential-based loan. It will be higher for businesses. We've used 7.26%. The loan term, 30 years versus 5 years, and the gross annual income. So this is the gross annual income that would be generated by the rent of $40,000 per year. That's roughly a 4% yield, and which is fairly typical. And for an established business, the business would be generating around $420,000 worth of profit if you're paying about $1 million for the business. Operating costs of the property have to be factored in. The $420,000 for the business is already after all the operating costs. And now let's look at the approximate annual principal and interest repayments. So for an investment property, you'll be paying $66,900, and for a business, $119,600 over 5 years. If you look at the interest component of that, that's where it's pretty scary, because in an investment property, of that $66,000, you're paying $56,000 in interest. Under a 5-year term, you're paying $34,000 in interest because the term is shorter, there's just a lot less interest loaded to the front. What's left over after taxable income? Well, in an investment property, you're going to be down around $24,000. In a business, you've got $385,000 left over. Now let's factor then in tax. You're going to get taxed significantly on the business. Assuming the tax rate's 27.5%, you'll be paying tax of $105,900. Now on the property investment side, let's assume that by some miracle you are eligible to negatively gear. So you'll get an uplift of $6,700. So that's reasonable. Now, having a look at then the net free cash flows, it's such a big difference. You're in a negative for the investment property, and for an established business, you've got net free cash flows of $194,000 a year. So your cash on cash return, and I think this is what people are most interested in, for $500,000, even after servicing the debt, when I put in $500,000, my cash on cash returns 39% net after debt servicing and after tax. So in a 5-year comparison, this is where things just get really wild. Look at the difference between the investment property and the established business. We do have to allow for some amortization of the principal over 5 years, but basically at the end of the 5 years, the business has earned $992,000 in free cash flow. The investment property has cost $138,000 in cash outflow just to simply hold the property. The amount of principal that's paid down in the property, because all of the interest is loaded to the front of the loan, is $57,000. And the amount of principal that's paid down in the business is the whole amount. And so the debt that's remaining after 5 years is still $843,000 on the investment property, and the entire business is paid off in full. Now, yes, you've invested $500,000 to buy that business and only $100,000 to buy the investment property. So the cash on cash return is just out of this world when you look at it this way. And this doesn't really take into account as well things like renovating the property or throwing more capital into the business to expedite growth. It also assumes that the business maintains at the level that it is, and that can be a dangerous assumption. But when you compare them side by side, to me, it's a risk that just makes so much more sense than buying an investment property. And the other thing is, at the end of the 5 years, you've got now $1 million of equity in the business. And I guarantee at the end of the 5 years, even if you have some capital growth in the investment property, you are not going to have anywhere near $1 million equity in the investment property. I mean, it would have to double in value in 5 years' time. So what stands out first is obviously the cash flow, but the second is the debt. The property gets cheaper money and it gets 30 years to pay it back. The business gets more expensive money and only 5 years to pay it back. Yet in this example, the business is still producing positive, free cash flow after tax and after servicing that much more aggressive debt. And in 5 years' time, the acquisition debt is gone. Now, there's a reason these numbers look so different. A business carries considerably more risk operationally than an investment property. So that additional return isn't free. You're being compensated for accepting a different type of risk. But this is also where I think first-time buyers often get their acquisition strategy a bit backwards. Their natural instinct is to start small, buy a small business, put less money at risk, learn as you go. That sounds sensible, but smaller doesn't mean safer. In fact, the smaller the business, the wobblier the wheels. There's less management, less depth in the team, and usually a much greater reliance on the owner. And you move into a more established business and you can start seeing management structure, people who are not the owner making a lot of decisions, systems that don't live entirely inside one person's head, and enough cash flow to actually support that infrastructure. So if you think buying a 1 million investment property makes sense for you, go for it. But if you are willing to take on a bit more risk or balance a real estate portfolio with a cash producing asset, buying a business could be an excellent opportunity and next step for you.